So at 15%, right, $100,000, you're only going to be able to buy like a $500,000 facility, right? Maybe 500, 550, something like this, right? That's 20%, right? That's 15%. So like, I say 600, 650,000, something like 550 to 650, let's say something like that, depending on the deal. Right. So you want to make sure, and you just kind of like, if you have $100,000, you just reverse engineer, how much money can I put down? Oh, okay, then I should really just be looking for these types of deals. So a mismanaged facility where you have to, you can buy like $500,000 to $600,000 and put down, 52 or it's like $675,000 or $100,000 or something like this. Okay. Because you may need some CapEx too, right? So you want to make sure that you save the money for CapEx if you need it. Especially for a mismanaged facility, you probably need some CapEx, right? Because they're just like, are a mess. We literally just closed on a facility. It was a $375,000 purchase, but it's a $200,000 in CapEx, right? So obviously that's like a severely mismanaged facility. We probably could have got an SBA loan for that, but I'm just, I didn't want to go through the whole like shebang of doing all that. So I just like raised the money. Okay, so $100,000 can get you a mismanaged facility. If you want to do a projection-based loan, and it's like between $500,000 and $600,000, let's say, something like that. Okay, so now in your mind, you're like, okay, now I know where what kind of a facility I can buy. Where can I go find this? And so then, okay, a $500,000 or $600,000 facility is not going to be in like Nashville, right? Or like Orlando or something like this. Okay. A $500,000 or $600,000 facility is going to be in a tertiary market. Tertiary equals country, right? In a smaller market, or maybe a secondary market. So for me, a secondary market is like 100,000 or less. I say 25,000 to 100,000 population. That's not oversaturated. Or a 25,000 or less, like little tiny town, something like this. Okay. And sometimes you can't find a $500,000 facility, even in a town that's like 5,000 people or less. And so it really just kind of just like, it just hangs, like it depends on your area as well too. Okay. So for instance, like, in Florida, there's a lot of like little tiny towns, but they're suburbs of like all these bigger areas. So obviously that's not going to work as a secondary market or a tertiary market, right? A tertiary market is really like a standalone. Like I live in the panhandle of Florida now, and I mean it's very tertiary, honestly. And so, this is like the perfect place to find like a $500,000 or, $600,000 facility. So where are those tertiary markets? And I just had a student in the panhandle close on a facility. It was 110 units. And it was like almost 400 grand. It was like 389 or something like this. Okay. And it was a mismanaged facility. They had not raised rates in like 10 years. Okay. So I would say probably a $500,000 or $600,000 facility it's not going to get you much. It's not going to get you much anymore, man. Gone are those days. So, so just keep that in mind. And I would just be focusing on tertiary markets. But like some areas, like maybe Missouri, Missouri has a very low price per square foot. And so you might be able to, find a $500,000 or $600,000 facility in a secondary market, right? Not in the touristy areas, but in like, a little tiny, a little secondary market town or something like that. So just keep that in mind. Okay. So mismanaged facilities, $100,000 will get you a projection-based deal. That's what it will get you. Okay. Most of the time with mismanaged facilities, you need to raise the money. That's why I said I bought a $375,000 facility and I'm going to put 200 grand into it. So I had to raise the money for that. All right. That is most of the time with mismanaged facilities, you have to raise that money. Okay, or you have to have cash for it.